Jensen Huang's keynote today looked like a product presentation. But from an investment perspective, I think it was something bigger. This was not just Nvidia showing off another chip. This was Jensen Huang telling the market that Nvidia does not want to be valued as a normal semiconductor company anymore. The bigger message was this: Nvidia is trying to become the infrastructure layer for the AI economy, not just GPUs, not just servers, not just gaming cards. Nvidia wants to sit inside the AI factory, the enterprise agent, the AI PC, the robotic system, the autonomous vehicle, the data center network, and the software layer that connects all of it. And if that roadmap works, Nvidia's addressable market is much larger than investors used to assume. But there is also a danger. When a company is already priced for greatness, a bigger story does not automatically mean a better entry point. So the real question after Jensen's keynote is not simply, is Nvidia a great company? The real question is, how much of this future is already priced into the stock? The first thing I picked up from Jensen's presentation is that he is trying to move the AI conversation from hype to economics. He did not just say AI is exciting, he said useful AI has arrived. That matters because the market has been asking one major question. After all this spending on AI chips and data centers, where is the return? Jensen's answer was clear. AI is becoming productive. AI is creating output. AI is improving software development. AI agents are starting to do real work. And if AI produces real work, then compute is no longer just a cost. Compute becomes a revenue engine. That is why one of the most important lines from the keynote was when Jensen said, AI is now a profit generator and a GDP generator. For investors, that line is not just marketing. It is the foundation of Nvidia's long-term bull case. Because if companies believe AI compute produces revenue, they will keep buying compute. And if compute produces revenue, the AI data center becomes more like a factory than a traditional server room. That leads to the second major point. The biggest phrase in the keynote was not GPU, it was AI factory. Jensen's message was that customers do not just want to buy computers, they want to build AI factories. That is a major shift. A normal data center stores data, runs applications, and supports cloud workloads. An AI factory produces tokens. Those tokens become answers, code, images, agents, workflows, automation, and eventually revenue. So Nvidia is trying to redefine the data center as an industrial machine. And when you look at it that way, Nvidia's addressable market changes completely. The market is no longer just the GPU inside the rack. It becomes the entire factory. Chips, CPUs, networking, storage, security, cooling, power management, software, simulation, operating systems, and factory-level optimization. That is why Jensen talked about DSX, factory simulation, power budgets, cooling systems, and grid coordination. He is saying, if 1 gigawatt of power can produce more tokens and those tokens create revenue, then performance per watt becomes a financial metric. That is a very important investment point. Nvidia's moat is not only that its chips are fast. The moat is that Nvidia wants to optimize the entire AI factory so customers get the lowest cost tokens and the highest revenue per watt. That is how Nvidia defends itself against cheaper chips. The argument is simple. The cheapest chip is not the best chip if it produces fewer profitable tokens from the same power budget. The third thing I picked up is that Nvidia is deliberately moving up the stack. Jensen basically laid out a roadmap where Nvidia touches almost every layer of AI infrastructure. The GPU is still the heart of the system, but it is no longer the whole story. There is Vera Rubin, there is Vera CPU, there is NVLink, there is Bluefield, there is ConnectX, there is Spectrum, there is networking, there is security, there is storage, there is software, there is an enterprise AI toolkit, there is a runtime for agents. This is Nvidia saying, we do not want to be one component in somebody else's architecture. We want to define the architecture. That is why Vera Rubin matters. Jensen said Vera Rubin is in full production, and even more importantly, he said the supply chain for Vera Rubin is twice as large as Grace Blackwell. That is a very strong demand signal. It tells investors Nvidia is not preparing for the AI cycle to cool down. It is preparing for the next wave to be larger and more system level. But it also raises the bar. If the market already expects massive Blackwell demand, then Vera Rubin has to keep the growth story alive. Nvidia cannot just be good, it has to keep exceeding expectations. The fourth point is agentic AI. Jensen's view is that the old computing model was applications running on an operating system. The new model is agents, a model, a harness, tools, skills, memory, and a runtime. That might sound abstract, but the investment implication is very direct. Training large models created the first huge wave of GPU demand. Inference created the next wave, but agents could create an even more persistent wave because agents do not just answer one question. They reason, call tools, access databases, write code, check results, use memory, and run continuously. That means more compute, more CPUs, more GPUs, more memory, more networking, more storage, and more security. This is also why Jensen talked about CPUs built for agents. His argument is that traditional CPUs were built for humans. Humans think in seconds. Agents operate in nanoseconds. Every delay slows down the next step. So Nvidia is not only going after GPUs, it is also going after the CPU layer inside AI infrastructure. That has consequences for Intel and AMD. It does not mean they disappear, but it does mean Nvidia is trying to pull more of the data center value chain into its own platform. This is where the investment story gets interesting. If Nvidia succeeds, the impact spreads far beyond Nvidia shareholders. Dell, HPE, Supermicro, and Lenovo may sell more AI servers, so their revenue may not decline. In fact, AI demand could help them grow, but their strategic position could weaken. If Nvidia defines the rack, the chip, the networking, the software, and the factory blueprint, then the server companies risk becoming integrators of Nvidia's architecture. That can mean higher revenue but weaker margins and less control. Apple is different. Nvidia is not directly attacking the iPhone or Apple's consumer ecosystem, but with RTX Spark, N1X, Microsoft, and MediaTek, Nvidia is trying to create an AI-native Windows PC platform. That matters because Apple has spent years proving that tight integration of silicon, software, and hardware can win the premium device market. Now Nvidia is trying to bring an AI-first version of that idea to the Windows ecosystem. Will Apple revenue decline immediately because of this? Probably not. But if local AI agents become the next major PC upgrade cycle, Apple will have to prove that its own AI devices can compete with Nvidia-powered Windows machines. The pressure is more direct on Intel, AMD, and Qualcomm. Intel is exposed because Nvidia is entering CPUs for agents and AI PCs. AMD is exposed because Nvidia is expanding from GPUs into complete AI platforms. Qualcomm is exposed because Nvidia and MediaTek could become a stronger AI-native Windows alternative. Networking companies are also impacted. Cisco, Arista, Broadcom, and Marvell can all benefit from AI infrastructure growth, but Nvidia is also trying to own more of the AI networking stack with NVLink, Spectrum, ConnectX, Bluefield, and Photonics. So the impact is not simply winner versus loser, it is more subtle. Many companies may grow revenue from AI, but Nvidia may capture the highest value layer. So what is Nvidia's addressable market after this keynote? I would split it into 3 layers. The first layer is near-term and very real. AI factories, data centers, inference systems, networking, and enterprise infrastructure. This is where current revenue can actually come from. The second layer is mid-term, agentic AI, enterprise agents, AI CPUs, private AI clouds, local AI workstations, and AI PCs. This is where Nvidia is trying to expand from the cloud into the enterprise and the personal computer. The third layer is long-term, robotics, autonomous vehicles, physical AI, smart factories, satellites, industrial systems, and humanoid robots. This is massive optionality, but investors should not overvalue it too early. The cleanest way to think about Nvidia is this. In the conservative case, Nvidia remains the dominant AI chip leader. In the base case, Nvidia becomes the dominant AI infrastructure platform. In the bull case, Nvidia becomes the toll road for the AI economy. That is the real power of Jensen's roadmap. He is not just increasing Nvidia's product list, he is increasing the number of markets where Nvidia can take a toll. But here is the discipline investors need. A larger addressable market does not automatically mean the stock is cheap. Nvidia is already one of the most valuable companies in the world. The market already knows it is dominant. The market already knows AI infrastructure is a massive opportunity. So the key question is not whether Nvidia has a big future. The key question is whether future earnings can rise faster than the expectations already built into the stock. That is why this keynote is both bullish and dangerous. It is bullish because Jensen strengthened the long-term case. It is dangerous because the bar is now even higher. If AI factory economics prove real, if agents create sustained inference demand, if Vera Rubin ramps smoothly, and if Nvidia captures more of the infrastructure stack, the company can keep surprising investors. But if AI capex slows, if customers question returns, if competitors win custom silicon, or if margins compress because the market becomes more competitive, then even a great company can become a difficult stock. So my takeaway from Jensen Huang's keynote today is this: Nvidia is not thinking like a chip company anymore. It is thinking like an infrastructure company. It wants to own the AI factory, power the agents, define the AI PC, simulate the physical world, and become the platform underneath the next computing cycle. That makes Nvidia's addressable market much bigger than GPUs alone. But it also means investors have to be more disciplined, not less. Because when a company is trying to become the toll road for the AI economy, the upside can be enormous. But when the stock is already priced for greatness, the margin of safety matters more than ever. This is not financial advice. Do your own research, watch the valuation, and remember, a great company is not always the same thing as a great entry price.